Welcome to Tax Strategies that Build Your Wealth. This is strategy number 2 of 5 for financially successful small business owners who want to join the 2% Club. In this segment, we'll explain how your tax returns affect your business valuation. We'll discuss how perks and other benefits are handled in the process of a business valuation. We'll talk about how your equipment purchase decisions affect business value. We'll cover how owner-occupied real estate works into your valuation. And we'll go over at least 4 case studies of how to use your business valuation in support of tax strategies that minimize your taxes and build your wealth. So let's get started. What you need to know is that the tax returns are the most credible document the valuation analysts will look at in the course of doing a valuation on your business. The tax returns establish what the historical trend has been, and they are the gospel truth. We use the historical trend to project the future earnings because, after all, it's the future cash flows that you're selling in your business, not the historical cash flows. What the history does for us is it tells us what people will believe, what a buyer will believe, what a bank will believe, and even what a potential investor will believe in terms of your projected future cash flows. So when we see a historical trend, a nice level, even uphill trend like this, we're liable to project future earnings in a similar pattern. That's very clean, very credible. Lots of people will believe it. So let's talk more about the details in the tax return. First, it's the most credible document, the most believable document, again, the gospel truth. Your tax returns tell us a story. Think about it. Do you know what story your tax returns tell? They allow us to compare you statistically to the industry. Valuation analysts are going to look to see if what your tax returns say is normal for the kind of industry that you're in. If you're a Main Street business and you're going to sell your business to a Main Street buyer, most likely they're going to use SBA financing, which means the bank is going to look at your tax returns to establish the cash flow that's necessary to support the debt that they're issuing in order for your buyer to buy this business. So your tax returns are going to be the deciding document that both the bank and the SBA are going to rely on to establish that this business has enough cash flows to be able to pay that debt in the future. Again, this is very important to the story that your tax returns tell. And remember, consistent and clean records will reduce the perception of risk by all parties involved: the buyer, the bank, the SBA. A clean, consistent set of records will produce a very low perception of risk and help you get your business sold. Now, looking at the 98% and all the reasons, or more specific, all the bad reasons that valuations are done, most valuation analysts are also certified in financial forensics. And so we're trained to look for deception in the valuation process or in the financial statements. So let's turn this around and let's say we, the valuation analyst, is working for a buyer, and this buyer is thinking of buying your business. What advice are we going to give this buyer, and how can you learn from that? Let's look at the red flags of risk. We're going to look for things that tell him that there's a risk to the cash flow stream. Anything that doesn't make sense is a red flag of risk. If your tax returns don't look statistically normal, that doesn't really make sense. They should be somewhere close to the industry standards in order to really be believable and credible. Abnormalities are going to be heavily scrutinized. For example, if we look at a series of tax returns and see the cost of goods sold percentage going up and down, that's an abnormality that indicates one may be manipulating the inventory value to manipulate the profit. And if the profit's manipulated, then the perception of the cash flow stream has been manipulated. It's a red flag of risk. Sloppy records, sloppy tax returns, and sloppy financial statements are terrible red flags of risk. One of our valuation analysts once had an individual give him a handwritten financial statement and tell him he wanted his business valuation based off of that. When asked for bank statements so that the analyst could see the deposits that would support all of the revenue that was on there, the individual couldn't provide any bank statements. Needless to say, the red flag of risk was everywhere, and we didn't provide a valuation. I don't believe that business ever got sold. A good set of quality returns, quality financial statements, very clean and very well kept, will go a long ways to reducing the perception of risk and help you exit your business successfully through a sale. Substantial discretionary add-backs are another cause of a red flag for risk. We once had an individual hand us a tax return that showed a $100,000 profit, and then proceeded to also hand us a list of discretionary expense add-backs that added up to another $100,000. So what he was asking us to do was add the profit of $100,000 and add back $100,000 of these expenses, which he said were discretionary. Things he was writing off in his business that weren't necessary for the business. So effectively, he was asking us to double the cash flow from $100,000 to $200,000, thereby doubling the value of that business. That's a huge red flag for deception. And we're going to tell our buyer in every circumstance, when there's substantial discretionary add-backs, you don't want to get involved with this business. There's a really high risk that things are not right, that you're overpaying for it, or that these are not discretionary expenses, etc. If you've been doing $100,000 a year for the last 3 to 5 years, and now you've come to tell us that in the next 3 to 5 years, you're going to increase by $300,000 to $500,000, well, that's a little unrealistic to us that it would change so substantially. That's a red flag of risk. And chances are you're going to actually have to have 3 to 5 years of history of doing that $300,000 to $500,000 of profitability before anybody's going to believe that financial projection and actually place a value on your business that way. So again, remember, the tax returns tell the story. The last thing we want to say, if it looks too good to be true, it probably is. You've all heard it, but Bernie Madoff is a great example. He returned 15% a year in and year out, through all of the tough times to his investors, and it just wasn't true. There's a lot of fraud and deception in investments, and so it's wise to pay attention to what things are red flags and not to have red flags in your records. Now let's talk about perks and other benefits that affect the value of your business. Let's remember the rule for value. Cash flow times multiple equals value. So will the following add value to your business? The use of a company car, shareholder meetings in Hawaii, fancy titles and other perks, pride of ownership, flexibility in the schedule. The answer is, if those things don't improve your cash flow or they take away from your cash flow, then they take away from value. If they don't improve your cash flow, they don't improve the value. This is especially true with middle market companies because the buyers are very sophisticated in evaluating only the investment return. But sometimes in Main Street businesses, you'll find a very unsophisticated buyer who will come in and place a lot of value on those things because they're not thinking about it as an investment. We once met a guy who sold a big house over in Seattle and made a large profit on that sale. He came over to Spokane and invested that money in a business. He valued pride of ownership. He was excited about owning his own business and being his own boss, but he failed to recognize the cash flow from the business was zero and that he was only buying a job that would barely pay him enough to survive. After 5 years, he shut the business down and took another job and didn't get any money for it. He was an unsophisticated buyer who placed a lot of value on perks, benefits, flexibility of schedule, and pride of ownership, but failed to recognize that it's an investment and that the investment return, the cash flow, is what substantiates that value. Finally, let's talk about equipment purchase decisions. Again, the rule is cash flow times multiple equals value. So will the following add value to your business? New delivery vans, modernized equipment. The answer is again, unless it improves the cash flow of your business, it doesn't improve the value. If buying new equipment merely keeps the cash flow level, then it's called an expense. An equipment expense will be able to sustain your cash flows and sustain the value. But if adding equipment increases the profitability, then it's an investment and will improve the value of your business. Now, coming up in part 2, we want to talk about owner-occupied real estate. It's the first of the tax strategies that build your wealth. Watch the next segment as we explain to you why owner-occupied real estate can be so powerful for you.